Today we discussed about the some introductory issues of auditing. The term audit is coined from a Latin word audior, which means to hear. In earlier days, the accounts were verified and certified by the auditors after hearing from the accounting parties. This manner of conducting audit has been changed over the period of time. Why the manner of auditing changes? This manner of auditing changes because nowadays accounting has different complexity, different changes has been incorporated in accounting process. Therefore, only by hearing and checking and verification of the accounts is very much difficult is very much difficult. Ritik, you are late. No person or organization can effectively carry on its activities without the help of proper records and accounts. When we talk about the accounting process or the objectives of the accounting, the first and foremost objective was to record the transactions. So, until and unless the proper recording has been done, it cannot carry out the other accounting activities. The effect of all the transactions has to be recorded and analyzed to see the results as regard the business as a whole. That means if we find out the financial position of any organization, the proper recording of all the transactions and their effects on the financial position should be analyzed. Financial statements are often the basis of decision making by the management. What types of decisions are we have to take through the accounting information? In one word, in each and every decisions you have to take with the help of the information depicted in your financial statement. The management takes so many decisions on the basis of the financial statement, and therefore the authenticity of the financial statement is very essential, and such authenticity of accounts can be assured with the help of an independent audit. That means the basis on which the financial decisions are taken, the information on the based on which the decisions are taken should be authentic one. Otherwise, the decisions will be wrong. So, in order to check the authenticity of the financial statement, auditing is the only tools that establish the true and fair picture about the financial position of any organization. Actually, audit is performed to ascertain the validity and reliability of information. Examination of the books of accounts with supporting vouchers and documents in order to detect and prevent error and frauds is the main functions of auditing. The goal of an audit is to express an opinion on the financial and non-financial areas. Audit safeguards the financial interest of persons associated with the management or not associated with the management. That means audit safeguards the financial interest of all the stakeholders of the organization. However, due to constraints, an audit seeks to provide only the reasonable assurance that the statements are free from material error. In case of financial audit, a set of financial statements are said to be true and fair when they are free from material misstatements. That means a financial statement of an organization exhibits true and fair view only if it is free from material misstatements. But recently, argument that auditing should go beyond just true and fair view is gaining momentum in view of recent frauds by high profile organizations in convince with the reputed audit firms. That means nowadays the periphery of the auditing, the boundary of the auditing is not only establishing the true and fair view, because different high profile organizations, the big organization may manipulate the financial statement with the help of the audit firms. Therefore, the scope of the audit has now been very large beyond establishing true and fair view of the financial statement. This is the background of the audit. So, audit deals with the checking, verification, and examination of accounts. Three things: checking, verification, and examination of accounts. The audit also used in all ancient countries like Mesopotamia, Greece, Egypt, Rome, the UK, and India. In Kautilya's Arthashastra, it has emphasized the importance of accounting and auditing. And auditing evolved and grew rapidly after the Industrial Revolution in 18th century. With the growth of the joint stock companies, the ownership and management became separate. In India, the Companies Act 1913 made an audit of a company accounts compulsory. With the increase in the size of the companies and the volume of transactions, the main objective of the audit shifted to ascertaining whether the accounts are true and fair rather than true and correct. That means that I told earlier, different giants organization may manipulating their financial statements with the help of the different audit firms. Therefore, the auditing is not only concentrating on establishing the true and fair rather than true and correct picture of the organization through its financial statement. Different authors in this field give the different definitions of auditing. According to A.W. Hansen, an audit is an examination of such records to establish their reliability and the reliability of the statement drawn from them. Another example given by R.B. Bose: audit may be said to the verification of the accuracy and correctness of the books of accounts by an independent person qualified for the job and not in any way connected with the preparation of such accounts. That means, as per the definition of Bose, the auditing must be a separate activity. and must be done by an independent person who have the enough qualities, enough educational qualifications for performing this job, and that person or that organization has not has not been connected with the preparation of such accounts. After analyzing the definition, the following features of the auditing can be highlighted. Auditing is a systematic examination of accounts by an independent person to give transparent view of books of accounts. Very simple. It is a systematic examination. It is not an haphazard examination. And that examination must be done by an independent person. That I told earlier, that person or that organization doesn't have any relationship regarding the preparation of the financial statement. And the objective is to transparent the views of books of accounts. Number one. Second feature, time, extent, and nature of audit depend on effectiveness of internal control system of an organization. That means when that auditing is required, to what extent it is applicable, and what types of auditing is required, that depends on entirely on the internal control system of an organization. Third, it may be done on test basis or in-depth examination of accounts. That means finding out the different information, you have to test whether that particular information exhibiting the actual picture of the organization or not, or in detail or in-depth examination of the account. Maintenance of the account is the function of accounting. Auditing has nothing to do with it. That means where the accounting ends, auditing starts. This is very simple. Functions, maintenance of the accounts, it is solely depends on the accounting policies. Auditing has nothing to do. Auditing has only focused on in-depth examination of that accounts. Auditor has to report that accounts have been prepared as per the GAAP. GAAP means generally accepted accounting principles, and presents a true and fair view of the business organizations. What are the objectives of auditing? The objectives of the auditing are classified into two heads. One is primary objective, not two heads, under three heads. Primary objective, subsidiary objective, and specific objective. What are the primary objectives or the main objective? The main objective is the expression of expert opinion. Expression of expert opinion. That means that means auditing is to verify the accounts and records and to report to the owners of the business whether the profit or loss accounts and the balance sheet have been properly drawn up, accounting to the requirement of the law, and whether they exhibit the true and fair view of the profit of the financial position of the business. That means auditor, as an auditor, you express your opinion that that financial statement of a particular organization has been properly prepared, maintaining the or following the laws, rules, and accounting regulations, and it also exhibit true and fair view of the profit reported in the financial statement. In order to achieve this, what auditor do? The auditor do the examination, the internal control and internal check, and verify whether the books of accounts as required by law are kept, verify whether proper accounting principles and procedures are followed or not, check the arithmetical accuracy of the books of account, verify the authenticity and validity of the transaction, confirm the existence and the values of the assets and liabilities by physical verification, find out whether the material statement is properly drawn up, report whether the profits and loss give a true and fair view of the profit or loss for the year, and the balance sheet gives the true and fair view of the financial position of the business at the end of the financial year. That means, in order to express the opinion, how you express the opinion, whether it is correct or not, that means you have to go through a thorough internal control and internal checking. What you check? You check the accounts. First of all, the accounts, books of accounts, which are as per the law existing in the for the time being. Next, you have to verify that particular accounting policies and principles are followed or not. You know that there are different accounting principles, there are different accounting procedures regarding the valuation of inventory, valuation of fixed assets, valuation of intangible assets. So these principles are properly followed or not. After checking that it is okay, then you have to find out the arithmetical accuracy, whether the sum, reductions, calculations are correct or not. Verify the authenticity and the validity of the transactions. That means the record you have maintained, the based on which that records are maintained is a transaction. So then you have to find out the authenticity and validity of the transactions. Confirm the existence and the values of the assets and liabilities by the physical verification. That means the auditor, in the process of the thorough examination of the internal control and internal check, you have to physically verify the assets and liabilities. He or she should not be satisfied only the figures exhibited in the financial statement. You have to cross verify the values reported in the financial statement and the values by physical verification. Find out whether the financial statement is properly drawn up. That means you know that the each and every financial statement must have some pro forma. In earlier days, we prepared the balance sheet in a horizontal form. Now we prepare the balance sheet in the vertical form. So if nowadays, if a particular company prepare the balance sheet in the old system, it is not a proper. So whenever the financial statement is reported, it is to be prepared, it is required to be prepared as per the latest regulations applicable to that organization. Report whether the profit or loss give a true and fair view of the profits or loss for the year, and the balance sheet gives a true and fair view of the financial position of the business at the end of the financial year. That means financial statement, generally we consider the two types of financial statement. One is the profit and loss account, and another is the balance sheet. And profit and loss account, all of you know, exhibits the profitability of the organization, and the balance sheet exhibits the financial position. So profit and loss exhibit the financial performance, and the balance sheet exhibit the financial position. And as an auditor, you have to check the both and give on your opinion that the profit or loss reported in the financial statement is true and fair, and the balance sheet actually exhibits true picture of the financial position of the business organization related to a particular financial year. So this is the function as an expert expressing the opinion. What is the subsidiary or ancillary objective? It is not easy for the auditor to express the opinion regarding all these until and unless he performs the subsidiary objectives or ancillary functions. Subsidiary objectives of auditing are detection and prevention of error. Not only the detection of error is sufficient, auditor has to prevent the error, and detection and prevention of fraud. Two things. One is errors or mistake, and another is the frauds. Detection and the preventions of error, when the auditor is performing that auxiliary activities, are known as the errors refers to unintentional misstatement in the records or books. That means errors are unintentional. It are two types: clerical or technical error and error of principles. Clerical or technical error কি হতে পারে? Now, clerical error refers to all types of errors committed on account of clerical mistakes. All of you know, whenever you prepare the trial balance, whenever you rectify the errors through the rectifications of error, error of omission, error of commission, compensating error, and error of duplications, all are the clerical errors. The organization generally has no intention to make such errors. It is the default system. This is the system default. Error of omission, you know that a particular transaction has been omitted to be recorded in the books of account, either wholly or partially. And if the error of omission happens, what happens? Your trial balance is also tally. You can also prepare the balance sheet, financial statement, but there is a mistake. And an auditor have to check out, have to find out whether that errors of omission, partial omission or total omission has been occurred or not. An error of complete omission does not affect the agreement of the trial balance. Just I told, as both the aspects of the transactions are omitted from the trial balance and they cannot be detected easily. They can be detected only by an intensive checking of the subsidiary books. That is, the auditor has to check the ledger accounts, posting of the subsidiary books to the ledger. An error of partial omission affects the agreement of the trial balance because you record only one aspect of the transaction. The other has been omitted. As only the one aspect of the transaction is omitted from the trial balance, it can be detected easily. So whatever the nature of omission, partial omission or complete omission, then as an auditor, you have to consider it in a very significant way. You have to put proper emphasis whether a particular error of omission happens in your financial statement or not. The second clerical error, that is the error of commission. Error of commission refers to errors committed in the process of posting from subsidiary books to the ledger account, casting, carry forward, and balancing of the ledger account. That means, all of you know, the error of commission happens when you posted a particular transaction, say Mr. X instead of Mr. Y. So this is the error of commission, one type of error of commission. Or you carry forward the wrong amount to the next page of the ledger account. Or you make mistakes in balancing the ledger account. Some of the errors of the commission will not affect the agreement of the trial balance. They cannot be detected easily. Only a thorough checking of the subsidiary books and posting to the ledger can help to detect the errors. So suppose if you posted one transaction in Mr. X instead of Mr. Y. So what happens? Your trial balance will have tally. But there is an error of commission. So as an auditor, you have to check whether such an error of commission has been occurred or not. And the third clerical error is the compensating errors. All of you know when one error is compensated or set off by another error, it is known as the compensating error. And this is very dangerous because it doesn't affect the agreement of the trial balance. but errors remains in your accounting process. So that auditor has to check it. Error of duplication. Error of duplication arises when an entry in the books of original entry has been made twice and also been posted twice. That is duplicate entry you have passed. So if each and every figure are shown in an inflated price. You paid rupees 500 to someone, you recorded 1,500 in 2 times. So obviously your expenditure will increases, profit will decreases. Similarly, if income is recorded twice, your profit will be increases. That is not an actual picture, actual profitability of the organization. So this is the clerical type of error, and obviously this is the unintentional in general cases, unintentional misstatement by the organization. And second one, that is the detection in the preventions of error, that is the errors of principles. All of you know the errors of principle happens when the capital nature of transaction is recorded as a revenue nature. Suppose you purchased a furniture as an asset. So this is a capital transaction, capital expenditure. But you recorded the transaction through your purchase debut. That means your capital expenditure is treated as a revenue expenditure, and vice versa. Suppose you sold a plant and recorded in your sales debut. That means your capital receipt is recorded as revenue receipt. These types of errors are errors of principles. And as an auditor, we have to perform the thorough examination whether these types of errors of principles has been occurred or not. Because errors of principles doesn't affect the agreement of the trial balance. Only the detailed and intensive checking will reveal these errors. So this is the dangerous errors that may sometimes occur in your accounting process. The second part regarding the about the ancillary objective, detection and prevention of fraud. Till now, this is the detection and prevention of errors, that is clerical or technical errors and errors of principles. And so far, the detection of the preventions of fraud, what the auditor has to do, it is an intentional and willful representation or deliberate concealment of material fact. Detection of errors that has been occurred in an unintentional way. But the frauds is an intentional activities, willful representation or deliberate concealment of the material fact, intending to deceive, cheat, or mislead somebody. Fraud may be classified into 3 types: misappropriation of cash, misappropriation of goods, and manipulation of accounts. Manipulation of accounts. Okay. So 3 types in 3 areas such frauds may happen. Misappropriation of cash. All of you know the embezzlement of cash. Fraudulent appropriation of the cash belonging to another person by whom it has been entrusted. Misappropriation of cash may take place in the following ways: suppression or non-disclosure of the cash receipt. Suppose someone paid the cash to you, you not disclose the same in your financial statement. Misappropriating the receipt by not recording the same in the cash book. Entering the lesser amount on the counter folio and misappropriating. The difference between the money actually received and the amount entered in the counterfoil of the receipt book. That is the misappropriation of cash. Or it may occur by not recording the receipts of sale of casual nature, of example, sale of scrap, sale of old newspaper. This is also the income. But if it is a lower amount, you intentionally ignoring by recording as an income. So this is the misappropriation of cash. By omitting to record cash donation received by the non-profit making charitable institution. Suppose certain non-profit making charitable institution received donation from someone or from some organization, but it has not been recorded as an income. So this is the embezzlement of cash. Suppression of the non-disclosure of the cash receipt. By misappropriating cash received from debtors and concealing the same by giving a artificial credit to the debtors in the form of bad debt, discount, or sales return, etc. That means you receive the cash, but you recorded there is further credit given to debtors, or it is recorded as a bad debt, or discount or sales return. By adopting the methods of teaming and ladding or lapping process, this is one of the methods of misappropriation of cash. Actually, the misappropriation of the cash, one of the frauds, intentional mistakes, willful mistakes, deliberate concealment. Under these methods, cash received from the first customer is misappropriated by the cashier. The money received from the second customer is credited to the account of the first customer. The money received from the third customer is credited to the account of the second customer. And the money received from the fourth customer is credited to the account of the third customer, and so on. That this process is carried out throughout the year. And in this way, the actually money received from the customer has not been recorded. By suppressing the cash sales, by not recording them or treating as a cash sale as a credit sale. If cash sales are not recorded or the cash sales are recorded as a credit sale, that means misappropriation of the cash. You conceal the receipts of cash. By misappropriating the sale proceeds of VPP sales or sales on goods on approval basis, by treating the transaction as goods receipts or not approved. So these are the possible cases. These are the possible, or rather right to say, these are the very simple cases of the cash embezzlements. But in reality, there are varieties of ways you can embezzle the cash or misappropriate the cash. These are some examples. Similarly, in the payment cases, in the case of cash payment, you also make the same types of mistakes. Recording the personal expenses as the business expenses, showing the credit purchase as the cash purchase, payment of some amount at a figure higher than the actual payment of pocketing the difference, recording the fictitious payments of expenses, record dates of the payments of a dummy workers. So, with both the cases, regarding the cash receipt and the cash payment, there are lots of possibilities. There are lots of possibilities of misappropriating cash. And all these possibilities are made by the organization or the person concerned in intentional way. It is his or her deliberate activities to mislead somebody, to cheat somebody, to deceive somebody. The second types of frauds is the manipulation of the accounts. Manipulation means the falsification of the account without any misappropriation of cash or goods. That is to say, the presentation of the accounts more favorably than what they are. You inflated your profitability, you inflated your assets position, but you are not misappropriating cash. How this is possible? How you make false accounts? No provision for depreciation on fixed assets. If you don't make any provision for depreciation on fixed asset, obviously your asset value is very high. Or the actual provision and the recorded provision, there is a difference. That is, you make a provision less depreciation on fixed assets, or provision of more depreciation on fixed asset, or you may show overvalued valuation of assets, undervaluation of the liabilities, recording revenue expenditure as capital expenditure, recording capital expenditure as revenue expenditure, prepaid expenses are showed in the current year, next year income are shown in the current year profit and loss account without recording the accrued expenses in the current year's profit and loss account, not recording the accrued income in the current year's profit and loss account, omission of prepaid expenses, omission of received in advance, window dressing. This is the very common way of frauds. What is window dressing? It is a practice by which the balance sheet is made to show a state of affairs that is different from the actual state of affairs. You are giving polish in your balance sheet. Generally, the practice of window dressing is adopted to make the balance sheet show a state of affairs for far better than the actual state of affairs. And such window dressing is an intentional activity to deceive someone, to cheat someone. And this is very dangerous. And all the other points that I've told, no provision for depreciation on fixed assets, provision of less depreciation on fixed assets, are the part of the window dressing. So actually, window dressing is done in the balance sheet to exhibit a better state of affairs. So these are the auxiliary objective. These are the auxiliary objective, ancillary objectives of the auditing. And what are the third category? Specific objective. So, first of all, an auditor has to achieve the primary objective, then subsidiary or auxiliary objective, and then he or she or that his or her organization comes to achieving the specific objective. Because until and unless our primary objectives are fulfilled, that is, until and unless the auditor is able to express his expert opinion that the subsidiary objectives cannot be achieved. Frauds, detection of the frauds, prevention of errors cannot be possible. So after making a positive, or after give a positive notion, getting a positive intention or positive image about the organization, after performing the subsidiary or ancillary objective, then he or she has to go for the specific objectives. The specific objectives depends on the type of the audit. Say, for an operational audit aims to evaluate the existing operation of the entity to give expert advice to improve their efficiency. Whereas in the case of cost audit, he or she has to check the cost record of the entity to make the report regarding the ascertainment of the cost of production. That means to say, that I want to say, according to the nature, the specific objectives of the audit has also been changed or required to be changed.